Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Sal Bruno, investment strategist at Nasdaq Global Indexes, and Chuck Fuller, portfolio manager at Nasdaq Dorsey Wright. We're here to discuss 2025 asset class rankings and index performance as the market broadens out into year end. It's great to have the both of you with us as always. And Sal, here we are, yet another double-digit gain in the markets this year, with starting with the two.
Yeah, I mean, it's been a great year. We probably may not have forecasted this early on, maybe around April, May time period. It was a little tough to see that we would end up this way. But, we've had a very strong recovery. When the market's up over 45% from the lows that we saw in early April with the Liberation Day announcement of the tariffs. That took the market down about 23%. And we've rallied about 44, 45% since then. So, right now we're looking at somewhere around 18, 19% year-to-date return, 20% if you count today. It's been a strong day on the CPI news. And what's really interesting, though, is when we look at what's driving that, it's really been from corporate earnings. So you look at the earnings for the NASDAQ 100 companies, they're up on average around 18 to 20% on a year-over-year basis, which roughly matches the return that we're seeing in the marketplace. So what that tells us, and if you look at sort of the PE ratios, the multiples assigned to those earnings, they haven't changed much this year. So pretty much all of the gains in the market that we've seen have come from earnings and not from multiple expansion. In fact, the multiples actually gone down a little bit. If you look at the price earnings ratio, either on a trailing earnings or forward earnings, it's actually come down. So it's been a little bit of a headwind even. So probably more than 100% of the return has come from strong corporate earnings this year.
Yeah, and it's a key distinction to make when you're talking about multiples, whether it's Nasdaq 100, S&P 500. Chuck, U.S. equity is still number one in your asset class rankings. Has it been number one all year, or I think we might have had some movement 1 or 2 months?
Yeah, I think there's maybe like a month, kind of around the time that Sal was talking about in April, May, where it may have switched down to number 2 or number 3. But like you said, I mean, the recovery has been incredible. It swiftly came back to number 1 in our rankings. And it's probably been there for, my guess, is 6 months or so now. And things just keep on moving up. We just recently hit a new closing high on the S&P 500. Didn't quite hit a new all-time high, looking at the actual high price of it, but we came close. And that's after seeing the market kind of dip a little bit, kind of in early November. We were starting to get a little bit worried about that. It was kind of one of these situations where some of the stronger stocks or the bigger stocks that we in the economy had kind of still been moving up, but underneath the surface, a lot of the average stocks were pulling back pretty hard. But I would say since basically the end of November, we've kind of seen a complete about face with that, where a lot of the smaller stocks in the market have really been rallying really good. And so typically we call that breadth, at Dorsey Wright. And all that means is just the average stock is doing well. It's not just the big guys. But yeah, they've been storming back quite a bit. We've basically seen breadth come back to new all-time highs. And like I said, that's good to see. Usually, deeper pullbacks in the market tend to happen when it's a very narrow market. Kind of like what we have been seeing leading into that. So, and really the degree to which some of these names have come back, when you look back at other times in history, there tends to be very good forward returns from seeing something like this happen. So we're pretty hopeful that the next year will just be another continuation of what we've already seen.
Yeah. And Sal, when we take a look at the indexes that we report on to kind of glean what sectors have been leading the way, what themes in the market have been leading the way, over 90% are positive year to date. What can you tell us about what's working and where there's underperformance?
Yeah, so we've seen very strong performance, not just in the NASDAQ 100. And to Chuck's point about breadth, 2/3 of the companies in the NASDAQ 100 have reported so far positive, posted positive year-to-date returns, and the average stock is up 15%. So a lot of the headline goes to, the Mag 7, the mega caps, the NVIDIAs of the world, Amazon, Google, Meta, Microsoft, et cetera. But really, it's been somewhat broadening out lately. And we've seen the average stock up 15%. When we look across the entire lineup that we report upon for our indexes, as you mentioned, 90% of them are positive. And that's really been led by metals, especially silver and gold miners. Those have had very strong years. Some of the metals performance, I think, is on it's up on some inflation concerns, and precious metals tend to be inflationary hedges there. So I think there's some of that going on. We've seen very strong performance in technology in general and semiconductors specifically. Companies like Nvidia and Broadcom were down pretty hard early in the year. First on the DeepSeek news, on different AI training model at the end of January, and then on the tariff situation that hit them pretty hard. But they've rebounded sharply, and they are near leaders across the Nasdaq 100. And then international has actually had a really strong run as well, and that's been sort of helped out by a weakening U.S. dollar. We're seeing one of the weakest U.S. dollars, one of the weakest years for the U.S. dollars in quite some time, and that becomes a headwind for U.S. stocks to some extent. But international stocks get the benefit for U.S. investors because they're basically domiciled in a local currency, a foreign currency, which is actually appreciating in value relative to the dollar. So when you bring those back into the U.S. dollar, you get an extra 6 or 7% return, and that's really helped the international markets do well. On the weak side, we've seen digital currencies, digital assets like crypto, things like Bitcoin have had a rough go of it this year, and they're sort of on the lower end of the performance. USD has been down, and oil until very recently has had a bit of a tough year. It's rallied a little bit on some of the saber rattling in the Gulf with the U.S. and Venezuela, and blocking oil deliveries from Venezuela. So that's given it a little bit of a boost. But basically, oil's been pretty weak all year.
Mm-hmm. And Chuck, what about fixed income? Still in last place, but it had a decent year.
Yeah, it really did. I mean, we're up, somewhere around 6.5% or so, looking at the ag. And, the really, when you look at rates, we've seen a little bit of a breakout here recently, got up to 4.2% in the 10-year. It's pulled back, some today with the inflation news, which is good to see. And we kind of saw that it was getting a little bit toppy there, so not completely unexpected to see it pull back some. But I think one of the big things that I've been talking about with fixed income lately is the MOVE index, which is kind of like the VIX for bonds. It's continued to move lower for years, really after the 2022 meltdown in bonds. We've seen kind of had like this elevated MOVE index. And I would say just recently in the last couple months, we've kind of gone back to what I would say is more normal levels. So I think that's a really good sign going forward for fixed income. Looking at next year, I mean, hey, we've actually got yield, right? Like what we've had the past couple of years, that's still there. Don't see any signs of that going away at present. And if it's the average kind of fixed income year, the actual price levels will kind of oscillate in a range, and you'll collect your yield. And so I think we'll have a pretty good year coming up next year as well. Even though it's in last place in our rankings, our rankings are kind of a relative thing, and obviously they can't keep up with U.S. equities and international equities at this point.
Yeah, and speaking of international equities, aligns with the performance that Sal had mentioned within the indexes, up over 30% year to date, taking the number 2 spot. That really has been the trade, though, since the beginning of the year, regardless of what's happened from a fundamental perspective. But I think investors were just looking for value around the world.
Yeah, I think you're exactly right. The international has not been a good place to be. I mean, really, most of the time since 2008, and so their valuations have been pretty bad, or I should say, pretty good. Relative to U.S. equities, and I think it's just a combination of that, plus what Sal mentioned with the U.S. dollar, just being really awful this year, and helping out their markets, and then specifically, if we break it down to a regional level. Looking at areas like Latin America, I mean, Latin America's up, around 50% this year. And a lot of that ties into the commodities markets being so good. I mean, you've got silver that's up, I think, about 130% year to date. Gold, everybody knows about the gold trade. It's up 65%. And even some of the more base metals like copper, I think copper's up somewhere between 30 and 40%. So, Latin America specifically is just, it's like a perfect storm to help, raise those markets. But obviously, a lot of those factors, feed into areas around the world, not just Latin America. So yeah, it's been a great year for international. I think the key will be, can it keep up next year, right? We've seen this kind of thing happen since 2008, where international will have a really good year, and then it always tends to fall apart. So I think if we have another really good year in international next year, I think that'll start to maybe clear out some of the naysayers who say how it's just a one-time thing and it's gonna do what it typically has done over the last roughly 20 years. But we'll have to see what happens.
And Sal, to wrap up here, the Nasdaq 100 annual reconstitution that becomes effective this Monday, December 22nd. Tell us more about that. Does it mean anything for investors? What can we expect?
Yeah, so investors, I mean, we go through this as part of the rules is, NASDAQ 100 is a rules-based index methodology. And so the rules dictate that we would go through and every year do a reconstitution. This year, we have 6 companies being added. In total, they're a little less than 2% in aggregate. We also have 6 companies coming out, and that'll keep us at 100 companies in the index. And those 6 deletes coming out are less than 1% in total. And typically we see at the lower end of the market cap spectrum companies move in or come out. So not surprisingly, it's companies that have had strong performance over the last 12 to 24 months and whose market cap has climbed above to rank them within the top 100. Those are getting added. So these companies have been relatively strong performers more recently. And some of the deletions are companies who have not performed as well, and therefore their market capitalizations have dropped outside of the ranking of 100. So on average, about 3.5–4% total turnover investors can expect, and index funds will obviously have to trade to get in line with the index. Probably the bigger piece in terms of from a turnover perspective is the weights on some of the existing names do change. Some of those because the shares outstanding get updated. Companies do buybacks, they do share issuances, so we need to refresh the shares that we use. Some of it is in terms of how much is free float, how much is actually available for trading. Those numbers change over time, so we need to do refreshes on that. And then we have some limitations for diversification reasons in terms of maximum position sizes on certain names and groups of companies. So all totaled, you're looking at around 11% two-way turnover, including both buys and sells, and that will be effective companies. The funds will probably start trading in those, I would expect, on Friday to be in line with the index that opens with these new weights on Monday morning.
So as an investor, let's say I own the Invesco QQQ, which of course the Nasdaq 100 is the benchmark for that. I don't have to do anything.
You do not have to do anything. The portfolio managers at Invesco, they will get the index, they will do all the trading. And because it's an ETF, they generally try to do these transactions in the most tax efficient way possible. So for the end investor, it really is, it's interesting to look at, but there's nothing required on their end that they need to do.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.